Die Sprachübertragung beginnt jetzt. Alle Teilnehmer befinden sich im Zuhörermodus.
So, hello everyone. Welcome to today's webinar. It's Effects on COVID-19, Crisis on Private Debt, Dislocations in the Broadly Syndicated Loan Market. I'm very happy to welcome Bill Zucker, who is a real expert on this topic. He had been more than 15 years with Oaktree and is now with Adam Street. And I'm very happy he will be taking us through this webinar. But before we start, let's just spend a few minutes to also have a look on what other events will be following. So Roland, could you please turn, this is not working. So also this week, there will be another one. It's in German, it's Let's Go Digital. And then in June 25th, there will be another private equity webinar. This will be focusing on carve-outs. I think this is also very interesting. So just elaborating, well, sometimes M&A and private equity transactions maybe don't work the way or just delayed for whatever reasons, to give you some more insight on this. Then, of course, further webinars will be following after the summer break. So in July and August, there won't be many webinars or maybe also none, but latest starting on September, we will be back again, and we are already preparing very nice and interesting webinars for September. So please stay informed. Everyone who will be receiving our mails will see automatically whenever there's a new event upcoming. If you are not receiving those mails yet, then please have a look on our homepage or just send a brief email to me or Roland just asking to receive those mails. Okay. Private debt is today's topic. As you can see from Preqin, I mean, of course, this is no surprise. This asset class is rising and rising. Yeah, of course, even against the background of Corona, I think at the end of the year, it might rise again. So this is at least something I assume, but maybe Bill has a different view on this and will be sharing it. Then on the next slide, you can see some how fundraising had been developing in terms of number and funds and aggregate capital raised. I mean, also here, if you look right inside, it's no surprise what happened so far in 2020. I mean, of course, it's not full Q2 yet. It has been anticipated by Preqin, but here, I mean, this is really not surprising. What will be really interesting, and I think also Bill will be addressing some information to what development he will be expecting with respect to those graphs. What's going to happen in the second half of 2020. With this, I would like to. Just to hand over to Bill. Thanks again, Bill, for sharing your knowledge on that. And yeah, please, if you have any questions, all the audience, please feel free to just send us your questions in the webinar tool. At the end of this webinar, we will be having a Q&A session and taking up those questions. Thanks, Bill.
Okay, thank you, Annette, and BAI for inviting me to the presentation and hosting this event. I really appreciate it. And thank you to everybody in attendance. We appreciate your interest in this discussion on some of the dislocations that are occurring in the broadly syndicated loan market. After a brief intro on our firm, I'm going to talk about the post-COVID broadly syndicated loan market and the conditions that exist there today. Compare the market today to the market as it existed back in the global financial crisis. What that can tell us about what might lie ahead and some of the interesting investment situations there, and what investors can do to position themselves to benefit from further dislocations in the market should they occur. And so just for background, my buttons are not working. Roland, could you advance to the next slide? One more, please. Excellent, thank you. Adams Street is a global private market investment manager. We were founded over 45 years ago in 1972. Chicago-based firm with over today $41 billion of assets, and they're distributed across 5 core strategies that are very synergistic with one another. We run one of the largest primary fund-to-fund businesses that invest in middle market private equity sponsors. We also run one of the largest secondary fund-to-fund operations. And then we have a couple direct strategies. We have a co-investment arm, invest alongside private equity sponsors at the portfolio company level. A growth equity business that's investing directly in late-stage venture and growth-oriented companies. And then private credit, which is the business that I run, that is likewise benefiting and providing capital to private equity sponsors across the world. As you can see, we have offices all over the world, 10 in total. We're in Boston, New York, Chicago, Menlo Park on the West Coast in the States. In Asia, we're in Beijing, Seoul, Tokyo, and Singapore. And in Europe, we have offices in London for over 25 years and Munich as well. With that, let's set the stage. The coronavirus, its effects, and the ensuing economic shutdown that ensued has really created significant uncertainty for both the financial markets and the economy. On the market side, in the span of just 3 months since the shutdown, the S&P 500 had dropped almost 30% from 3,200 to about 2,400. And then after a short period of time, rose again by about 32%. And by the end of May, was basically back where it started at about 3,200. Conditions in the last week or so, as you know, looks like a weak opening today, has become more volatile again, but we'll see where that all takes us. In the real economy, the near-term effect has likewise been very significant. While recently May retail sales that were just reported surged 17%, the Atlanta Fed estimates that GDP in the second quarter here in the United States will be down, I think, an unprecedented 48.5%. Also, with the unexpected non-farm employment rising 2.5 million people, just reported again in May, there are still 21 million people out of work in the US, and the unemployment rate currently sits at a little bit over 13%. And just to put that into some context, the unemployment rate in the US peaked during the great financial crisis at around 10.6%. So it's a relatively significant number. While I don't think we want in any way to minimize the seriousness of the crisis that confronts us, both in health terms and in economic terms, in disrupted markets like this, there are investments that tend to present themselves in the broadly syndicated loan market. You can occasionally, with windows like this, be able to purchase syndicated senior debt at discounts sufficient to produce equity-like returns between 18 and 30%, but with senior debt like underlying risk. Unusual combination of features, and that's going to be the subject of our discussion. Roland, if you could advance one more slide. Thank you. So let's take a look at what's happening in the broadly syndicated loan market today. This chart reminds me of one of those polygraph tests in a crime drama when the suspect being questioned starts to lie. But what you are looking at is the pricing and yields of broadly syndicated senior loans going back to January of 2019. And you can see in the unshaded portion of that graph that loan prices tend to hover within a point or two of par in normal markets. And you can see in the line on the bottom that had resulted in yields that were running between high fives and around 7%. When the Corona crisis began to kick in the shaded portion of that graph on the right, you can see how dramatic an effect that had on the loan market. We saw prices drop by about 20 points from the high 90s to the high 70s, and the attendant yields jumped from around 6% to around 11.5%, 500 basis point widening in the span of about a month. Like the equity market, we have seen also a pretty significant recovery in the near term. Prices have moved back up, but as you can see, not back to where they were. They're currently hovering in the low to mid 90s. And yields likewise have recovered, but they still trade, a bit wide of where they were before. Roland, if we could flip one more slide. Okay, so let's compare now how the market today looks like relative to where it was back during the financial crisis. And while the loans themselves have remained pretty much the same, the market itself has really evolved quite a bit. And so starting at the top, first looking at size, the market has grown in size quite a bit. Issuers have gone from about 825 in 08 to around 1,200 today. It's about a 50% increase. The outstanding principal amount of the debt has effectively doubled from 596 to around 1,200. And in terms of holders, the market has become, increasingly more concentrated. When I started in the business, mutual funds, or more commonly named prime-based funds, dominated the market. Today, it's CLOs. Even back in 08, CLOs were in their ascendancy. They represented about half of the debt outstanding in the market. Today, they dominate with about 70% of the holdings in the total markets. So that CLO point is important to remember. I'm going to go over that again in some detail. In terms of quality, the loans today are a bit less quality than they were back in 08. If you look at covenant light, these are the deals without effective covenants. They represented about 17% of the market back in 2008. Today, it's about 90% of the market. Virtually all the deals that are getting issued get issued without covenants. And in terms of leverage levels, the peak back in 08 was just inside of 9 times. Just inside of 4.9 times. and today it sits at just inside of 6 times. And then in terms of ratings, the percentage of the market that was represented by single B and below credits was less than 30% in '08. Today, it represents about 55% of the total market, a very significant increase, and is a vital credit statistic to remember as we proceed into the presentation. Roland, can we advance another slide? Actually, 2 slides. Thank you. What does this portend about the future? We thought we'd start by looking at a couple of the other market dislocations. This goes all the way back to the great financial crisis, that big dip all the way on the left. And the other periods in the last 11 years or so, where we've seen prices dip below 90 cents on the dollar. And then including our current situation, which is all the way on the right. As you can see, the pattern differs quite a bit. What's the difference between these more moderate dips that we've seen around the European sovereign debt crisis that coincide with U.S. rating downgrade, and then the Asian market meltdown that occurred in 2016. The difference here is dips that were accompanied by economic downturns. And Roland, if you can flip to the next slide. Let's see, exactly what that means for the great financial crisis, which was a significant dip, but also one that had an accompanying economic recession. And you can see that these don't come in one single downturn. They tend to evolve. And they also tend to come with a series of downturns, recoveries, and then downturns, the magnitude of each successive one being bigger than the one that preceded us. And so looking at how that evolved in the great financial crisis in the summer of 2007, the mortgage-backed security hedge funds that were run by Bear Stearns started to fail. That was the canary in the coal mine for the housing crisis that would follow, in part because of loss of confidence and dramatic changes in the market. A number of months later, Bear Stearns files for bankruptcy. You can see the market recovers again. And then, of course, Lehman Brothers fails, and the financial system throughout the world began to collapse. And we saw a significant decline, dramatically bigger than the two that preceded it. During that period, it took about 2 years to go from 90 cents on the dollar at the beginning, where Lehman Brothers failed, to coming back out the other side, recovery back to 90 cents on the dollar. Roland, if you could flip one more slide, please. So this leads us to the central question of today's discussion is, was this a short-lived blip in the broadly syndicated loan market, or really the beginning of a deeper, more protracted downturn to come? And the answer to that is that much will depend on what happens in the real economy. Is this a downturn that we'll see an accompanying economic recession? And you will also see that CLOs are likely to play a significant role here. And why CLOs? If you remember from that early slide, they represent 70% of the outstanding senior loans in the broadly syndicated loan market. And they have many features and characteristics that are homogeneous. So when changes begin to occur in that sector, they tend to be very widespread. And so let's start a little bit with a primer on CLOs. First, they are highly levered investment vehicles that are designed to hold broadly syndicated senior loans. That's all they do. They currently hold, as I said, 70% of the outstanding loans, and they are funded with small layers of equity and then multiple layers of debt with different rating characteristics. The equity in these vehicles, to give you a sense of the degree of leverage, are generally levered 9-to-1. So significantly supercharged underlying vehicles. The waterfall of cash flows generated by the underlying loans, all the coupon interest payments to the various tranches of that debt are strictly governed by covenants. And one of the central and important covenants are over-collateralization tests. How much of that tranche of debt in the cap structure is over-collateralized by the underlying loan assets. The greater the over-collateralization, the higher the rating. A key over-collateralization test in these CLOs governs the amount of CCC, or the lowest rated loan paper, that they can hold. Those limits vary a little bit from CLO to CLO, but they are generally around 7.5% of the total portfolio. If those CCC limits are breached, cash flows cease flowing to the equity and eventually the junior debt in the cap structures as well, and are diverted to pay down the debt at the highest rated tranches first, the tranches that are first in line. So the cheapest debt is getting repaid first. CLOs that find themselves in this position become highly motivated to begin to sell loans that are held in that portfolio in order to get back into compliance and have that cash flow resume going back to the junior debt and then ultimately the equity. That's how the equity derives its return. Okay, Roland, can we flip one more slide, please? So, let's take a look at what's actually happening with the CLOs and in particular CCCs. This chart is tracking the upgrades, which are the blue bars, and the downgrades across the broadly syndicated loan market. You can see that for much of the period post-financial crisis, all the way on the left, been pretty even in both directions. But if you look all the way on the right, for May 2020, we have seen an unprecedented, greater than what we saw in the financial crisis, number of downgrades. This has caused the percentage of outstanding CCC paper in the market to jump from about 6.4% to currently 9.2% today. Remember, CLOs, which represent 70% of the outstanding paper, generally have a 7.5% limit. And in addition, according to S&P, close to half of the single B and below paper are currently on credit watch with negative implications. And if you recall again one of those early slides, the single B and below paper represents more than half of the total amount of outstanding paper in the marketplace today. The implication to all this is that if a recession ensues and we start to see more downgrades, represented by those loans that are on negative watch, CLOs will be in one of those highly motivated positions to sell loans in mass in order to get back into compliance. Roland, if you flip to the next slide. So let's try to take a look specifically at what's happening with the CLOs. This information is a little opaque, so it varies depending on the source a little bit. But according to JP Morgan, 72% of the CLOs they follow are currently failing their S&P CCC test, and about 40% are failing their Moody's CCC test. From Barclays' perspective, they reported that U.S. broadly syndicated loan CLOs that they follow are seeing more than 14% of the collateral downgraded or placed on negative watch. From Bank of America, they think that nearly 30% of U.S. CLOs are currently carrying CCC assets in excess of their limits, that 7.5% threshold. And for the first time since the financial crisis, we already have a CLO that has failed both its junior and senior debt over collateralization tests. And that's all the way up through the AA tranches in that particular structure. And then from Wells Fargo's perspective, they reported that U.S. CLOs doubled their exposure to CCCs. And that's from the period of March 31st to April 22nd. And that currently sits at 8.1%. During this time, 150 CLOs exceeded their CCC portfolio limits of 7.5%. That's more than half of Wells Fargo's 206 sample set. And then lastly, S&P expects U.S. trailing 12-month speculative grade, this is this market, corporate defaults to hit 12.5%. To put that in some perspective, in the Great Financial Crisis, defaults peaked at 10.8%. So from S&P's perspective, they are expecting a material level of defaults that might, in fact, exceed what we saw back in the financial crisis. Roland, if you could flip one more slide. So, just to conclude on some of these thoughts, the central question is, was this a short-term blip, or are we really witnessing the early stages of the next cycle? And candidly, that remains to be seen, but much of it is going to depend on the economic fundamentals and the depth of the downturn and how long it takes to recover. What we are going through right now is without precedent. So it's hard to look at historic patterns and draw firm conclusions. The best we can do is look at those patterns and make some educated guesses. Our hypothesis is that if there is an economic downturn, you're going to see more downgrades, more CLOs will be out of compliance and failing their test, and there will be more windows of buying opportunity to come. If this were to occur, as you could see from some of the prior cycles, these opportunities may present themselves, but those buying opportunities tend to be relatively short-lived. They'll come and go quickly. And so one of the keys for investors is to be committed and in position in advance of the downturn, so that you can acquire that debt quickly. And given the level of uncertainty, the cost associated with being wrong and not having this window open up again is relatively low. If the commitment is made and the market opportunity does not present itself, then the capital won't be deployed. But if you wait too long for that downturn to present itself, you're likely to miss the window. And so it's very important to be prepared in advance. And then lastly, just one thought to leave everybody with is that selection of those underlying loans is really critical. While senior debt in this market is first in line at the top of the debt stack and is secured, those loans are still not immune to losses. And so being able to identify the good loans that are getting dragged down with the bad loans, especially if S&P is right and defaults begin to spike at around 12%, will be the difference between enjoying those private equity-like returns and actually having the underlying risk associated with it be true first lien $1 senior debt. And so with that, that concludes my prepared remarks. I know we have some time left for questions, and would love to take some if you have them. And thank you very much again.
Thanks, Bill. This has been a very interesting presentation. Maybe to start with some questions. You outlined, well, if recession is going on and downgrades increase, CLOs will sell those loans. So maybe could you please elaborate in more detail how this selling is done? Is this always in an auction, or how is this process, and how do, just to better understand how those loans are sold?
Yeah, so the broadly syndicated loan market is an actively traded market, and the facilitation of those trades are generally conducted through the agent bank that was involved in issuing the loans into the market in the first place. And those, are the big global banks for the most part. So market participants, have to sort of be involved in the market and pre-approved the trade. So, certain managers will be in a position to do that. If they are organized in the right way, they will have pre-selected the loans that they want to buy. And when the pricing window opens, they will generally go to those agent banks. Sometimes there are other third parties that participate as well, but generally go to those agent banks and put in a bid for the paper.
Okay, thanks. I mean, still, if someone is buying those loans, not being a first-time participant of the loans, then of course you also receive terms and conditions of a loan you haven't agreed to before, so you maybe would have done it differently. So how is the risk of getting whatever documentation you don't like, or which is harmful to you as a let's say second-hand investor here?
Yeah, the risk is relatively high. It's a good question. As I pointed out earlier on in the presentation, the percentage of deals today that are Cov Light, represents 90% plus of the market. So there's a lot of weak documentation out there. And that is why I concluded by saying the selection of the underlying loans is critical. and you're not going to have enough time to do a document review or a credit review when the window presents itself. And so you need to be prepared in advance. You need to have your high conviction target list of names already identified and ready to go.
Okay.
And one of those areas to be careful on is covenants and documentation.
Yeah, no doubt. This is what I assume. You also mentioned several times, so investors be prepared. Talking about institutional investors, I mean, what do you mean? For which kind of institutional investors do you think is this kind of strategy of acquiring loans from CLO? For which kind of institutional investors in which kind of portfolio constructions? Where would you see something where you say, okay, you are an investor, you really should go for this kind of investment?
Yeah, so I think that because of the equity-like returns and debt-like underlying risk, that type of proposition should appeal to a very broad set of investors. And that would include equity-oriented investors and debt-oriented investors because of the nature and underlying characteristics of the asset itself. And so I think that is traditional insurance companies, pension funds, public and private, endowments and universities, and family offices, high net worth family offices. It's very hard for them to do that directly. There are a few that can, but most would need to engage a professional investment manager to facilitate the purchase of the debt and the construction of the portfolio.
Okay, and in terms of terms, maybe, I mean, we are talking about loans, so therefore we are also talking about terms. What is the normal or average term you are acquiring with these kind of loans from acquired by CLOs or from CLOs?
Yeah, so the general proposition is you acquire the loan at a deep discount, you know, call it 80, 85 cents on the dollar. And if you selected correctly, you know, that will not be a loan that defaults. So no workouts involved. And then wait for the market recovery. You know, as you saw from that previous graph, some of the recoveries, you know, tend to run in months. And the deeper ones accompanied by recessions like the Great Financial Crisis can run a year or two. And so when I cited that 18 to 30% return, the assumption was acquiring debt at 85 cents on the dollar and holding that debt for 1 to 2 years. So relatively short duration investment. If it's a 1 year hold, you'll end up at 30%. If it's a 2 year hold, you'll end up in the high teens with a little bit better cash multiple. Worst case, again, if you selected the loans correctly and there's no default, the worst case is you end up holding the loan to maturity and then get repaid. At 85 cents on the dollar, the yield to maturity is in the high single digits to low double digits. So again, if you selected your credit correctly, your downside return is you know, around 10%.
Okay, so I hope everyone can hear you properly. It's some kind of a time lag issue or something, but maybe it improves again. So far it was good. It's just for the time being a little bit difficult. One other question from the audience is, what will private equity funds do to restructure, secure their current portfolio?
I think that depends on the problem they're having with the underlying business. Some might involve just in the private market where, you know, you can negotiate with the holders directly. Some might involve just pure covenant waivers and amendments. If the problems are more severe, it might involve the suspension of some cash interest to provide the company with less of a cash flow burden and some additional liquidity. And then if you take that one notch too higher, might involve the private equity sponsor contributing additional capital to the deal to keep the company liquid and help buy enough time to ride out the cycle. In our personal view, one of the things that is different about where we are today than where we were back in 2008 is that private equity sponsors as a community have an unprecedented amount of dry powder. They tend by nature to be pretty supportive of their underlying portfolio companies. And as a result, it would be our expectation that if their portfolio companies need the liquidity, that they will be able and willing to contribute capital to help their portfolio companies ride out this particular cycle. Now, we're relatively optimistic about that.
Okay, thanks. One question with respect to currencies. I mean, will this be mainly US dollar loans to be acquired in the near future, or will it be a lot of euro, or what do you expect in terms of currencies of those loans?
Yeah, so I do think this is an opportunity that would tend to present itself in both the European market and US market. We were specifically focusing on the US market, which is just a lot bigger, but they do tend to be correlated, and so I think you could expect to see similar trends in Europe as well. I think we happen to find ourselves at a time where the currency exchange rates are more favorable than they have been in a long time. Now that both European rates and US rates are pretty close to zero. So I think you could probably acquire a currency hedge today that would not be terribly expensive, and you have a fair amount of return to work with that is in the high teens to 30%. So even on a hedged basis, I think you're looking at net returns that are still relatively attractive.
Okay. I think, Roland, I think we didn't receive any other questions, or do we?
Just have a look. No.
Okay. Yeah, I think then we are done in a way. So thanks a lot for sharing your views. And yeah, I think this has been very interesting, and I mean, here are your contact details, so whomever is attending this webinar, please feel free to contact Bill if there are any further questions or whatsoever. So thanks a lot to Bill, and to the audience. Hope to hear you soon in one of our other webinars. Thanks a lot.
Thank you. Have a good day.